Introduction to stocks. What you need to know. An overview of the stock market. What are stocks? Stocks represent ownership in a company. When you buy a stock, you're purchasing a small share of that company, giving you a tiny ownership stake. Why do companies sell stocks? Companies sell stocks to raise money for expansion and other business needs through an IPO, initial public offering. How do people benefit from stocks? People can benefit from stocks through capital gains and dividends, earning profits when stock prices rise, or receiving a portion of company earnings. What are stocks? Understanding stock ownership. Stock definition. A stock represents ownership in a company. Each stock is a share, a small piece of the company. Example: Apple. When you buy stock in Apple, you own a tiny piece of the company. As Apple succeeds, the value of your shares can increase. Why do companies sell stocks? The purpose of an IPO. Fundraising. Companies sell stocks to raise capital for growth and operations through an initial public offering, IPO. Expansion. The funds raised can be used to expand the business, develop products, or increase market reach. Why do people buy stocks? Earning through capital gains and dividends. Capital gains. Investors make money when the stock price rises, selling it for more than they bought it. Dividends. Some companies reward shareholders with periodic payments from their profits, called dividends. How are stocks traded? Understanding stock exchanges. Stock exchanges. Stocks are bought and sold on platforms known as stock exchanges. The NYSE and NASDAQ are two of the most popular exchanges. Brokers. Investors typically buy stocks through brokers or trading apps that facilitate the buying and selling process. What affects stock prices? Factors that influence the stock market. Company performance. If a company performs well, its stock price may increase. Poor performance can lead to a decline. Economic factors. Inflation, interest rates, and other economic factors can heavily influence stock prices. Market sentiment. Sometimes, investor optimism or pessimism drives stock prices, even without changes in the company's fundamentals. Risks of investing in stocks. Understanding stock market risks. Volatility. Stock prices can fluctuate rapidly, and the value of your investment can change daily. Losing money. There's always a risk of losing your investment if a company underperforms or the market declines. Key terms to remember. Understanding important stock market concepts. Stock and shareholder. A stock represents ownership in a company. A shareholder is someone who owns stock in that company. IPO and dividends. An IPO, initial public offering, is when a company sells shares to the public. Dividends are payments made to shareholders. Capital gains. Capital gains are the profits made when a stock is sold for more than the price paid. How to start investing in stocks. Steps to begin your stock market journey. Choose a brokerage. Start by selecting a brokerage platform or financial advisor to help you trade stocks. Research and diversify. Conduct research on companies and industries before investing. Diversify across sectors to reduce risk. Start small. You don't need a lot of money to begin. Some platforms allow buying fractional shares, so you can start with any amount. Closing summary. Wrapping up stock market basics. Understand the basics. Stocks offer ownership in a company, and their value can fluctuate based on several factors. Research and manage risks. Thorough research and diversification help manage the risks involved in stock investing. Start investing. With a broker and a bit of capital, you can start your journey toward building wealth through stocks. Thanks for tuning in, and I hope this gave you a clear introduction to the world of stocks. Don't forget to subscribe to the channel to learn more about investing every single week.